if we've understood revenues from sale of goods, understanding rendering of services is similar, it's easier. So number one would be, like we said earlier, that the amount of revenue that you will get must be measured reliably. Must be measured or measurable reliably. Number two is again similar from the previous point, that the cost incurred or to be incurred must also be measured reliably. Can you guess some point? We talked about future economic benefits. So
there should be some future economic benefits.
So there should be a gross inflow of future economic benefits. Future economic benefits to the entity. But there's one thing which is very critical to services. Okay? And that is the stage of completion of service. So give me an example of service. What is an example of service? If we are doing some training, is that service?
Yes.
Yes. If you go to a hotel, you stay in a room, is that service?
Yes.
You hire a consultant or you hire an auditor, is that service? Yes.
Yes.
Service is something that we cannot see, touch, feel. Right? It's not tangible, but then you can experience it. So whenever you are providing any service, we should be able to understand the stage of completion of service. Okay? So measure the stage of completion of service. Okay? This will have to be identified particularly at the end of the reporting period. So when we say reporting period, we are talking about end of the financial year or end of the quarter or end of the month, depending upon when are you recognizing the revenue. Okay? So let's take an example. If you have enrolled into a 2-year program, right? If you have entered into a 2-year training program. So let's say, and you paid the fees upfront for the full 2 years, right? As a training provider, if I have at the end of the year, how much of training is complete? 50%. At the end of the first year, the training is complete only to the extent of 50%. So my first year revenue would be only 50% of what the fees you've paid. The other 50% will be a liability for me. Okay? So let's say if we are talking about year 1 and year 2, you have paid a total of 50,000 rupees to me for year 1 and 50,000 rupees to me for year 2. Even if you have paid this at period 0, that is today, even if I have got the entire 1 lakh rupees today, but at the end of the year, at the end of the first year, my revenue will be only 50,000. Why? Because I have provided service only 50%. And the other 50% of the service is yet to be provided, and accordingly the other 50,000 will be a liability for me. So this will be a revenue and this will be a liability for me. Okay? So let's do a quick recap of what do we understand by revenue from rendering of services. The first 3 points are very normal, right? The amount of revenue must be measured reliably. So I should know that, okay, I am getting 50,000, 50,000, 1 lakh rupees. The cost incurred or to be incurred must be measured reliably. So I should be able to measure how much is the cost of providing the service to you. Okay? The inflow of future economic benefit. So I know that, okay, by this revenue or by this providing this service, I will be getting some future economic benefits, either cash or accounts receivable. There can be other examples of future economic benefits as well. Most important is, we should be able to measure the stage of completion of service or the transaction at the end of the reporting period. Okay, and we've already shared an example of training. It can be auditor, any service, right? So we've given examples of service. It can be auditor, consultant, engineer, training, whatever. Okay, we come to the next part, which is
Interest.
interest, dividends and royalties, right? So according to the standard, it says that any income or any revenue earned through use of the company's asset by somebody else. Okay, so for example, if I own a property, I have given it to you for rent. I have not sold it to you. It may not be a service to you, but it is my property which you are using, for which you will give me rent. If you use my brand, right, you will give me royalty for that. So there will be royalty. If I am giving you dividends, if I am earning dividends from you, if I have invested in your company, you will give me dividends, so that is revenue for me, correct? So the third part is interest, dividends, royalties, etc. Okay, so we take three specific examples. Interest. Interest is measured, interest income, and remember we are talking about income here.
Yes.
Okay, so interest income is measured using effective interest rate method. We will discuss it later as to what is an effective interest rate method. The second is dividend. Dividend is recognized when the right to receive the payment has been established. Okay? When is the right to receive the dividend income established? When we have declared the dividend. Correct? So, right to receive the payment is established. By the way, we know what is dividend, right? If I have invested in a company and the company has earned some profits, the company distributes dividends. Now that dividend would be an income to me. That is the shareholder. So, dividend. Third is royalty. Royalties are recognized on the accrual basis. And while recognizing royalty income, we will have to take into account the substance of the agreement. Okay, let's take an example. McDonald's. McDonald's is a company, correct? It gives out franchisees. So you go to a nearby McDonald's store, you buy a burger, you eat that burger, correct? Now this franchise store, this McDonald's store close to your home is a franchise owner, correct? Now this franchisee, for every burger that you buy, the store would be paying some royalty to the McDonald's parent company, the large company, the master company, the franchisor. Okay? So that store would have entered into an agreement with McDonald's. So that agreement, so substance of the agreement. So the royalty income will be charged on an accrual basis based on the substance of the agreement under which the royalty income is being received. Okay?
Yes, sir.
Any questions at all?
No, sir.
Can we do a quick recap?
Yes, sir.
So give me an example of interest income.
We invest in debentures and get interest.
So if you've invested into debentures, if you've bought some debentures, the company will give you interest, correct? So this interest is your income. You will account for it using the effective rate of interest. Now what is effective rate of interest? I'll give you a very brief overview of what is effective rate of interest. So remember we talked about IFRS in terms of fair value principle. IFRS follows fair value principle. So whatever is the current market rate of interest, based on that market rate of interest, you will account for your interest income. Okay? We will deal with specific examples with respect to interest income. In case of dividend, what is the example of a dividend? You've invested in the shares of a company. That company has earned some profit and that has given you dividend. So you will recognize dividend income when you have got a right to receive the payment. When do you get the right to receive the payment? When the dividend is declared. Very good, right? So then is when only you will recognize dividend income. And royalties, we've taken an example of McDonald's. It can be any example, right? Any company. So McDonald's, KFC, ICA, they are franchise owners. They give franchises to the business partners or to the franchisees. The franchisees pay some royalty. So royalties are recognized on the accrual basis based on the substance of the agreement. Any questions?
No, sir.
Thank you.